Have you ever wondered how selling more company shares affects your personal ownership stake? This is the core concept of dilution. Dilution occurs when a company issues new shares of stock, which decreases the percentage of ownership held by existing shareholders. Imagine owning 10% of a pizza. If the pizza is cut into more slices, your physical portion of that pie effectively shrinks. Companies usually dilute shares to raise cash for expansion, pay down debt, or attract talent through stock-based compensation packages. While dilution reduces your percentage, if the new capital helps the company grow significantly, the total value of your investment might still increase. Earnings per share is the profit allocated to each share of stock. Dilution often lowers this metric unless the company grows its total profits. Always look at why a company is issuing new shares. Growth-focused dilution is very different from dilution used to cover operational losses. Understanding these mechanics helps you track your real ownership in the companies you own. Thanks for watching and keep learning.